You know what's fascinating. Right now, as you're watching this, there are two types of people in the world. There are those who think they're saving money, and then there are those who actually understand what saving means. And I'm going to tell you something that might make you uncomfortable. If you're holding dollars in a savings account, you're not saving at all. You're participating in the greatest wealth transfer in human history, and you're on the wrong side of it. Let me explain what I mean. When you put money in a bank account, you think you're being responsible. You think you're doing the smart thing. Your parents did it, their parents did it, so it must be right. But here's what nobody tells you. That dollar you're saving, it's not actually a store of value. It's a unit of debt. Every single dollar in existence represents a loan that someone, somewhere, has to pay back with interest. Think about that for a second. The thing you're using to save for your future is literally someone else's obligation to pay money they don't have. Now, I want you to imagine something with me. Imagine you're at a casino and the house offers you a special deal. They say, "Hey, we'll hold your chips for you. We'll keep them safe." Sounds good, right? But here's the catch. Every year, the house takes 10% of your chips. Not because you gambled and lost. Not because you made a bad bet. Just because you left them there. Would you take that deal? Of course not. But that's exactly what's happening with your savings account right now. The official inflation rate, and we all know that number is cooked, sits around 3 to 4%. But your savings account? It's paying you maybe 0.5% if you're lucky. Some of the big banks are still paying 0.01%. That's not a typo. 1/100th of 1%. So every single year, you're losing 3% of your purchasing power. Minimum. Probably more like 7 to 10% if we're being honest about real inflation. Your groceries know it, your gas tank knows it, your electric bill knows it, but somehow your savings account doesn't. Here's where it gets really interesting. In 1971, something happened that changed everything. Richard Nixon closed the gold window. He severed the last connection between the dollar and anything real. Before that moment, a dollar represented a claim on gold. After that moment, a dollar represented, well, a promise. A promise from a government that's now $36 trillion in debt. A promise from a system that prints trillions of dollars whenever there's a crisis. A promise that gets diluted every single time the Federal Reserve fires up the printing press. And they've been firing it up a lot lately. During the pandemic, the Fed created more dollars in 2 years than existed in the entire first 200 years of American history. Let that sink in. More money created in 24 months than in 2 centuries. And where did all that money go? It didn't go to you. It went to banks, to corporations, to Wall Street. It inflated asset prices for people who already owned assets. And it destroyed the purchasing power of everyone trying to save in dollars. But here's what the smart money figured out a long time ago. There's something that's been money for 5,000 years. Something that every civilization, every empire, every kingdom has recognized as real wealth. Something that central banks are buying right now at the fastest pace in decades. I'm talking about gold. Now, I know what some of you are thinking. Gold doesn't pay interest. Gold just sits there. And you're absolutely right. Gold just sits there. It doesn't pay dividends. It doesn't generate cash flow. But you know what else it doesn't do? It doesn't get printed into oblivion. It doesn't get diluted by a central bank. It doesn't represent someone else's debt. When you hold gold, you hold something real. Something that took energy and effort to pull out of the ground. Something that can't be created with a keystroke. Let me tell you a story. In 1980, the average American house cost about $76,000. An ounce of gold was trading around $850. So you needed about 89 ounces of gold to buy a house. Fast forward to today. The average house costs about $420,000. Gold is trading around $2,650 per ounce. You know how many ounces you need now? About 158. So in dollar terms, houses went up. But in gold terms, houses actually got more expensive. But here's the thing. If you had saved in gold instead of dollars, you'd be in a much better position than if you'd just left cash in a bank account earning nothing while inflation ate away at it. Now let's talk about what's happening right now, because this is where it gets really interesting. Central banks around the world are buying gold at a pace we haven't seen since the 1960s. The People's Bank of China has been adding to their gold reserves for 18 consecutive months. Poland just announced they're increasing their gold reserves. Singapore, India, Turkey, they're all accumulating. These aren't dumb people. These are the people who understand the monetary system better than anyone. And they're moving out of dollars and into gold. Why? Because they see what's coming. They see a U.S. government that can't stop spending. They see a Federal Reserve that's trapped between inflation and recession. They see a dollar that's being weaponized for political purposes, and they want out. When Russia got sanctioned and had their dollar reserves frozen, every other country in the world took notice. They realized that dollars aren't really their money. They're just permission slips that can be revoked at any time. Gold can't be sanctioned. Gold can't be frozen. Gold can't be printed away. And it's not just central banks. Look at what the big institutions are doing. JP Morgan has been accumulating physical gold in their vaults. Goldman Sachs just raised their gold price target. Ray Dalio, one of the most successful hedge fund managers in history, has been warning about the debt crisis and recommending gold. These people have access to information and analysis that most of us can only dream about, and they're all moving the same direction. Here's something most people don't understand about the gold market. The paper gold market, the futures, the ETFs, the derivatives, is about 100 times larger than the physical gold market. That means for every ounce of real gold that exists, there are about 100 paper claims on that gold. It's the same fractional reserve game the banks play with dollars, except with gold. And what happens when people start asking for physical delivery? When they stop trusting the paper and want the real thing? That's when you get a squeeze. That's when price discovery breaks down. That's when the real value of physical gold reveals itself. We're already seeing signs of this. The premium on physical gold coins and bars has been elevated for months. Dealers are struggling to keep inventory. Delivery times are stretching out. The U.S. Mint has had to ration gold eagles. These are the early warning signs of a market that's transitioning from paper to physical. And when that transition accelerates, the people holding real gold are going to be very happy. The people holding paper promises, not so much. Now, let me talk about something that's relevant for a lot of people watching this. If you've got money in a 401k or an IRA, you might be thinking, this all sounds great, but my retirement money is locked up. I can't just go buy gold. Well, here's something you should know. You actually can hold physical gold in a retirement account. It's called a gold IRA, and it's completely legal and IRS approved. I put together a free guide that explains exactly how it works, how to roll over existing retirement accounts without tax penalties, and what you need to know. If you've got $100,000 or more in retirement savings, it's worth checking out. Link is in the description. No obligation, just information. All right, back to what's happening in the market. Let's talk about the supply side because this is crucial. Gold production peaked in 2018. We're not finding new deposits like we used to. The easy gold has been mined. What's left requires more energy, more capital, more time to extract. Meanwhile, demand is accelerating. You've got central banks buying. You've got institutions buying. You've got retail investors in Asia buying. And you've got industrial demand from electronics and technology that's not going away. When supply is constrained and demand is increasing, there's only one direction for price to go. But here's what makes this even more interesting. The cost to mine an ounce of gold has been rising. Between energy costs, labor costs, equipment costs, and increasingly difficult geology, the all-in sustaining cost for many miners is now above $1,300 per ounce. Some operations are closer to $1,500. That creates a floor under the gold price. Below certain levels, it doesn't make economic sense to mine. Production gets cut. Supply tightens further. It's a self-reinforcing cycle. Now, let's contrast this with what's happening in the dollar system. The U.S. government is running deficits of $2 trillion per year. That's trillion with a T. They're spending $2 trillion more than they collect in taxes. How do they fund that? They issue bonds. Who buys those bonds? Increasingly, the Federal Reserve. The Fed creates dollars out of thin air and uses them to buy government debt. It's the most elegant Ponzi scheme ever created. The government borrows from the central bank, which creates the money to lend, which devalues the currency, which requires more borrowing, which requires more money creation. It's a loop that can only end one way, and we're seeing the endgame play out in real time. Interest payments on the national debt just exceeded $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. Just the interest on the debt, and rates are still historically low. What happens when rates go higher? What happens when the bond market loses confidence? What happens when foreign buyers stop showing up at Treasury auctions? The Fed has to print more. There's no other option. And every dollar they print makes your savings worth less. This is why gold isn't just an investment. It's insurance. It's a hedge against the inevitable outcome of a monetary system built on debt and debasement. When you hold gold, you're holding something that exists outside that system. Something that can't be manipulated by central banks or politicians. something that's been recognized as real wealth for thousands of years. Let me give you another historical example. In Weimar Germany in the early 1920s, hyperinflation destroyed the currency. People who had saved their whole lives in German marks saw their wealth evaporate. A loaf of bread went from costing a few marks to billions of marks. Life savings became worthless. But you know who survived? The people who had converted their marks into gold, the people who had real assets. When the currency collapsed, gold retained its value. It always does. Now, I'm not saying we're headed for Weimar-style hyperinflation tomorrow, but I am saying the trajectory is clear. We have a government that can't stop spending. We have a central bank that can't stop printing. We have a currency that's losing purchasing power every single day. And we have an alternative that's been preserving wealth for 5,000 years. The question isn't whether you should have some gold. The question is how much and how soon. Here's something else to consider. Gold is nobody's liability. When you hold a dollar, you're holding a Federal Reserve note, a liability of the central bank. When you hold a bond, you're holding a promise from a borrower. When you hold a stock, you're holding a claim on a company's future earnings. All of these things depend on someone else keeping their promise. Gold doesn't. Gold is an asset, pure and simple. It doesn't depend on anyone's promise or anyone's solvency. In a world where trust in institutions is declining, where debt levels are exploding, where currencies are being debased, that matters more than ever. And let's talk about the geopolitical angle, because this is huge. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And they're backing it all with gold. China and Russia have been accumulating gold for years, preparing for a world where the dollar isn't the reserve currency. When that shift happens, and it's a matter of when, not if, gold is going to be at the center of the new monetary order. Think about what that means. For 80 years, the dollar has been the world's reserve currency. Every country needed dollars to buy oil, to settle international trade, to hold as reserves. That created artificial demand for dollars, which allowed the U.S. to run massive deficits without consequence. But that system is breaking down. Countries are tired of being subject to U.S. monetary policy. They're tired of their reserves being weaponized. They're tired of watching the Fed print trillions and export inflation to the rest of the world. So they're building an alternative, and gold is the foundation. Now here's where most people get it wrong. They think gold is just for doomsday preppers or conspiracy theorists. They think it's something you buy if you believe the world is ending. But that's not what this is about. This is about understanding how monetary systems work. This is about recognizing that every fiat currency in history has eventually failed. Not some of them, all of them. The dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. The British pound, once the world's reserve currency, has lost 99.5% of its value since 1900. Every paper currency eventually goes to its intrinsic value, zero. Gold doesn't go to zero. It can't. It's a physical element with unique properties that make it ideal as money. It's scarce, durable, divisible, fungible, and portable. It's been money longer than any government has existed. It will be money long after today's governments are gone. That's not pessimism. That's just history. So, when I say stop saving in debt and start saving in real value, this is what I mean. Every dollar you hold is a claim on a system that's designed to devalue your savings. It's a system where the insiders get rich and the savers get destroyed. Gold is the exit from that system. It's how you preserve your purchasing power. It's how you protect your family's wealth. It's how you ensure that the work you've done and the money you've saved actually means something in the future. And here's the beautiful thing. You don't have to go all in. You don't have to sell everything and buy gold bars. But having 10%, 20%, maybe 30% of your savings in physical gold? That's just prudent. That's just recognizing reality. That's just understanding that the game is rigged, and gold is how you stop playing.
Look at what's happening right now in the markets. Stock valuations are at historic highs. Bond yields are being suppressed by central bank intervention. Real estate is priced in inflated dollars. Everything is expensive in nominal terms because there are so many dollars chasing assets. But gold? Gold is still undervalued relative to the money supply. When you adjust for the expansion of the monetary base, gold should be trading well above $3,000 per ounce. Some analysts say $5,000, some say $10,000. The exact number doesn't matter. What matters is the direction, and the direction is up.
Because at the end of the day, this isn't complicated. You can save in something that's being printed into oblivion, or you can save in something that's been real money for 5,000 years. You can trust a system that's $36 trillion in debt, or you can trust an element that can't be created or destroyed. You can hope that this time is different, that somehow we'll avoid the fate of every other fiat currency in history, or you can prepare for the inevitable. The smart money has already made their choice. Central banks are buying gold. Billionaires are buying gold. Countries are buying gold. They're not doing this because they're pessimistic. They're doing it because they understand the math. They understand that you can't print your way to prosperity. They understand that debt has to be paid or defaulted on. They understand that currencies are only worth what people believe they're worth. And they understand that when that belief breaks, gold is what remains. So here's my challenge to you. Stop thinking of gold as an investment. Start thinking of it as savings, real savings, the kind of savings that actually preserves your purchasing power, the kind of savings that can't be inflated away by a central bank, the kind of savings that will still have value when the current monetary experiment ends. Because it will end. They all do. The only question is whether you'll be prepared when it happens. This isn't about getting rich quick. This isn't about timing the market perfectly. This is about protecting what you've worked for. This is about ensuring that your savings are actually savings, not just digits in a computer that represent someone else's debt. This is about taking control of your financial future in a world where the rules are rigged against savers. The choice is yours. You can keep saving in debt, watching your purchasing power erode year after year, hoping that somehow things will get better. Or you can start saving in real value, in something that's been money longer than any government has existed, in something that central banks are accumulating right now, in something that can't be printed, can't be debased, and can't be destroyed. The smart money has already decided. The question is, what are you going to do?